Namaste. Good afternoon. I, Vikas PB, Joint Secretary Unnathi, extend a warm welcome to one and all present here for a national level webinar organized by Unnathi, an initiative for student faculty development, Department of Commerce, SSMRV College on the topic an impact of Union Budget 2023 on middle income group. Unnathi is a unique initiative of Department of Commerce. It is established to promote the professional practices, technical knowledge among faculties and students. The main aim of Unnathi is to update both student and faculty fraternity about new concepts. In this regard, today's webinar session is arranged. Union Budget is an accounting document revealing broad policy positions of government and serves as a platform for financial reforms. Each and every individual in the country will be interested in Union Budget because directly or indirectly it will have impact on your household budget. Today, we all have gathered here to know more about impact of Union Budget 2023 on middle income group. I now request Mrs. Anusha, Assistant Professor, Department of Commerce, Convener, Unnathi, to welcome the gathering. Over to you, ma'am.
Good afternoon, everyone. On 1st February, the Finance Minister Nirmala Sitharaman presented the Union Budget 2023, the budget of Amritakal, a prospective budget for next 25 years. This budget is also considered as an added initiative of radical reforms which the present government believes in. The timing of the budget dragged the attention of various stakeholders, and the people observed this budget through curious eyes. It also has a political importance as the Union Budget 2023 would be a last full-fledged budget of the second term of Modi government. The major chunk of allocation went to infrastructure development and railways. The change in the slabs and rebate in the alternative tax regime attracted the attention of the middle income group. Reduction in surcharge and introduction of standard deduction, even in the alternative tax regime, perhaps helps the high income group. Union Budget 2023 focused on the structural changes, and the Finance Minister was not very keen to present the so-called popular budget. The analysis of budget is very much required to decode the provisions, merits, and obstacles of the budget to a common man. In this regard, Unnathi, Department of Commerce, has organized this national level webinar. I take this opportunity to welcome today's resource person, CA Sumith Raja, who is also an alumnus of SSMRV College. We are happy to have you as a speaker amongst us today, sir. I, on behalf of the Department of Commerce, SSMRV College, extend warm welcome to you.
Thank you.
I have immense pleasure to welcome our respected principal, Dr. S. Anil Kumar, sir, who is renowned academician, visionary, who is always an inspiration to each one of us. Warm welcome to you, sir. I'm very happy to welcome our respected director, Dr. Geeta R., an able administrator. Yes, sir. I welcome our director, Dr. Geeta R., able administrator and researcher to the gathering. Warm welcome to you, madam. I extend my warm welcome to Dr. M.S. Nagaraj, Head, Department of Commerce, Coordinator, IQAC, who guided us in organizing the session. Welcome to you, sir. I'm very happy to share that we have received around 370 registrations across India, including Tamil Nadu, Andhra Pradesh, Kerala, Chhattisgarh, etc. I extend warm welcome to all the delegates from various colleges and university. Thank you so much for joining with us, and warm welcome to you. I also take this opportunity to welcome all the teaching, non-teaching staff, technical team, Unnathi team, and student volunteers. Thank you so much for joining, and happy learning. Thank you.
Thank you, ma'am. The backbone of all our events is our respected principal, Dr. S. Anil Kumar. Sir is a renowned academician and able administrator. Sir has 4 decades of teaching and 2 decades research experience. Sir produced 6 PhDs. Sir produced 6 PhDs and 30 MPhils. Sir published.
Participants, please ensure that the
Sir published research articles in reputed journals and presented research papers in various international conferences. To mention a few, Griffith University, Australia, Harvard University, USA. Sir is an author of more than 30 books. Sir is a member of various academic bodies and is a member of NAC peer team. Sir is a visionary and invented 360-degree education for wholeness model for the holistic development of student, the result of which college has secured A grade in third accreditation cycle. Sir is a recipient of many awards. To mention a few, Sir received Abdul Kalam Gold Medal Award from His Excellency Dr. Antraj Bharadwaj, the then Governor of Karnataka. Best Faculty Award from Vivekananda College, Tamil Nadu. Lifetime Achievement Award from Novel Research Academy, Puducherry. Guru Vasishta Award from Dayananda Sagar Institution, felicitated by MS Ramaya Foundation on the occasion of Teachers' Day. The list is endless, but with due respect to time, let me contain my words. Sir, we are happy to have you as our mentor, and now I request you to speak few words. Over to you, sir.
Thank you so much. Good afternoon. And once again, I would like to welcome our resource person for this program, CA Sumith H. Raja, who was our student in 2013 batch, I think, 2013 batch. I'm very happy to see our own alumnus speaking about budget analysis and being part of this particular program. Really happy to welcome our own alumnus for this particular program, who has really succeeded, and he has achieved in his profession, and he is now today one well-known chartered account. He has a well-known chartered accountant company, and he's doing so well. I think we are really very happy on behalf of the SSMRV College and the RV Educational Institutions, and on my own behalf, once again, I really appreciate CA Sumith Raja for being the resource person for today's program.
Thank you very much, sir, for your kind words.
And also, I appreciate the convener of today's program, Professor Anusha, and her team, entire team of faculty and, of course, students who are responsible in organizing this particular program. So, once again, I would wish this program a success. Thank you so much. Thank you.
Thank you, sir. The supporting factor for all our events is our director, Dr. Geeta R. Ma'am has an experience of 18 years and had brief stints as an entrepreneur too. Ma'am has worked in various reputed institutions at different capacities. Ma'am's unique abilities and strengths as a professional are reflected by an exclusive professional experience in analytical skills, mentoring, lecturing, and academic publishing. Ma'am has published more than 30 research papers in various national and international conferences. Ma'am has served as member of BOE for VTU and BOS for reputed B schools like Alliance University and Garden City University. Ma'am served as managing editor of TIGA RCM International Journal and editor member of Samyoga, ARSCAM, and other journals. Ma'am also worked as independent research and management consultant and SME for leading edtech firms. We are happy to have you amongst us, ma'am. Requesting you to speak few words. Over to you, ma'am.
Thank you. Acclaimed Speaker of the Day, Mr. Sumith Raja. It's a proud privilege that we have our alumni who would be addressing the gathering. And we have distinguished delegates from various parts of the country. The coordinator, convener of the event, Unnathi event, Professor Anusha, and students who have volunteered to put the things together for this event. So it is really a privilege for us to listen from an acclaimed speaker today. And then I'm sure all of you would agree with me that this budget 2023 has laid out a blueprint for empowered and inclusive economy. And the topic that has been selected for today, that is impact of Union Budget 23 on middle class India being a consumption-driven economy. I think this is a very apt topic. You will definitely have an enriching experience listening to Mr. Sumith, who himself is a chartered accountant. Have a great enriching experience. Thank you all.
Thank you, ma'am. I now request Mr. Manjunath, student, final year BCom, Vice President Unnathi, to introduce our today's resource person, CA Sumith H. Raja, to the gathering. Over to you, Manjunath.
Very good afternoon, everyone. It's my privilege to introduce today's resource person, CA Sumith Raja, Alumnus SSMRV College, to the session. CA Sumith H. Raja, Proprietor, Sumith Raja and Associates, based out of Bangalore. Sir has completed his schooling in Bishop Cotton Boys School, pursued a graduation in Commerce from our SSMRV College, and articled with Manian Suresh Sundar and Vittal, Chartered Accountant, Bangalore. Sir qualified Chartered Accountant in 2018. Sir heads Audit and Taxation Department of the firm. Presently, Sir serving as Chartered Accountant and pursuing Diploma in Information System Audit, conducted by the Institute of Chartered Accountant of India, to provide services in the area of information, security, and business community. Sir is a member of Institute of Chartered Accountants of India. Sir, we are happy to have you amongst us, and we are eager to listen to you. Now you can take over the session, sir. Over to you, sir.
Thanks for the introduction. I would like to thank everyone from SSMRV College to give me this opportunity for presenting the budget. As you are very eager to learn what has changed, what has happened, how it is going to impact you, we'll go step by step. Is there someone who can play the presentation, the PPT? Are people able to view the PPT?
Sure, sir. I'll play it. 1 minute.
And you people are able to see the whiteboard?
Yes, sir.
Okay, we'll start. You can put on the first slide. So as you're aware, the budget is presented on 1st of February every year. As usual, even this year, the budget was presented by Honorable Finance Minister Nirmala Sitharaman ji. Whatever we are going to talk today pertains to financial year 23-24. That is from 1st of April 2023 to 31st of March 2024. Please keep it clear. This is not applicable for someone who's going to file their return in the subsequent financial year. Financial year 23-24 and assessment year 24-25. Can you please open the first slide? The first thing what the finance minister has mentioned is they want to simplify income tax return forms. Gone are those days when people used to go to a chartered accountant or a tax consultant. Please file my return. Now, gone are those days where you used to go to a chartered accountant or a tax consultant. So please file my return. Now that there is a lot of data which has been collected by the government itself from various sources. So what the government is planning is they want to do a simplified return wherein everything is preformed. Your income tax return, if you're basically a salaried employee or filing ITR 1, 2, 3, you yourself can fill your ITR form and file your ITR. There is no requirement of going to a chartered accountant today because the ITR forms have been simplified in such a way that it's easily fillable and doable by themselves. The taxpayer, the assessee himself can do that. That is one major change that the finance ministry has processed. Because whenever you see an income tax return form, it will be 30 pages, 40 pages. But the Department of Finance has told that this year they're going to simplify the income tax return form so that it is very easy for the taxpayer, that is the assessee himself, to fill his forms. The next one, PAN to be used as a common business ID. What the government wants to do today, the PAN will be the next, it's going to be the next Aadhaar for a business. So all the data which has been collected will be colluded.
So give me a minute, sir. What I'll do is I'll just mute everyone and I'll just make you the co-host so that there's no interruption in your session. So sorry for that. 1 minute, sir.
Fanny.
So 1 minute. So you have logged in as Sumith Raja, right? 1 minute, sir. Sir, I made you the co-host. Can you try speaking, sir?
Yes.
Yes.
Thank you so much.
Perfect, sir. There'll not be any interruption. Thank you, sir. Sorry for that. Thank you.
No issue. See, what the government intends to do, they want to use, see, as you're aware, every data is being collected in Aadhaar. Every data is being, I'm getting this host. Okay. See, what the government wants to do, they want to use the PAN as a common business ID for all businesses. So it is similar to what is being used by Aadhaar. See, what is happening in Aadhaar is every data of yours is being tracked by the government. There is very little scope when this is going to happen. There has been no scope for evasion itself, tax evasion, because every single rupee which comes into the account can be monitored. It will be like 100% foolproof. I'll just give you a small example. You're all aware that if you go deposit into the bank 50,000, you require a PAN number. You know what the reason why they ask you a PAN number? The reason is that in case there is an accumulation of 50,000 and that crosses 10 lakhs in a year, that goes into a pop-up into the income tax department, and they collate the information and compare it with your income tax return. Assume you have deposited 50,000 per day over a period of over a period of an year, for a period of a year, and what has happened is it's accumulated to 20 lakhs. However, when you file your income tax return, you have made sure that you only file a nil return. What has happened over there? You are showing 4 lakhs, 4.5 lakhs. However, in the annual income tax return statement, AIS, they have found out that there is a cash deposit of more than 20 lakhs, which is not comparable at all. So all that evasion, there's something called as this SFT is going to make sure that all high value transactions are going to be tracked from the government. So this will reduce the scope of tax evasion. So this will be the next big thing wherein all the data of all businesses. See what happened, sales changed, your purchases are tracked because of GST. Have you ever imagined yourself, you are opening your income tax return to file your income tax return, you have a total summary of what is the total purchases you have made during the year, what is the total sales you have made, and you cannot even withdraw more than 20 lakhs of cash in hand today. What happens in case you have to withdraw more than 20 lakhs? You have to separate an letter to the certificate to the banker saying that I have filed my return for the past 3 years, and I'm using this for the purpose of my business. So what happens? Why all this is being done is one small thing is that assume you're going to withdraw cash that goes out of the system. There is no chain of the tracking of that cash. However, if there is any digital transaction that can be tracked, it cannot be going into illegal funding, hawala, and crime. All that will get stopped out because of this. The next one. as you're aware, there has been no changes in the old regime. The only changes which have been done is to make people adopt the new scheme. So there's no changes in the income tax in the old regime. The second change is as you're all aware that up to 7 lakhs, the income has whatever income you are going to earn, that has been exempt. Can you just move on to the next slide? So, can someone follow it up and so it will be easier for them? Tell you, we'll have an in detail discussion which regime is better, the older regime or the new regime, which is better, and how do you need to judge yourself. There is not a single correct answer saying this is an NS for a new regime or a no. It is like a combination of various things which needs to be factored in before you choose which regime is going to be better for you. So we'll have an in-depth discussion going ahead. Which regime you're going to have? What is the benefit of a new regime? What is the drawbacks of the new regime? And how is it going to help you out? Then going to the next one, surcharge on, see, there is a reduction of surcharge from 37% to 25% if your total income exceeds 5 crores. That is one reduction, which is a reduction in tax surcharge, which is going to help large taxpayers. I'll just repeat it. And if you feel that we're going faster, I'll reduce my speed. Surcharge on total income, if it is going to exceed 5 crores, it's going to reduce from 37% to 25%. The next one, benefit of standard deduction. This was not there in the earlier new regime. Now, in order to help people adopt the new scheme, they have increased this deduction from 0 to 50,000. This was not allowed before. And there are a few small changes, compliance wise and all. Just do that. The next page. Post office monthly income scheme. So what has happened? There was a monthly post office scheme wherein the maximum limit of that was from 4.5 lakh increased to 9 lakhs. And for a joint account, 9 lakhs to 15 lakhs. The another major changes is insurance premium policies where premium paid is in excess of 5 lakhs. The whole amount in excess of 5 lakhs when it is matured, it will be taxable. But it will, in case there is a death, maturity on account of death, it is exempt. The next one is the maximum deposit limit for senior citizen scheme is increased from 15 lakh to 30 lakh. I don't personally feel that this is a great move because see, today senior citizen scheme you are able to get around 8% of interest on senior citizen scheme. However, there are much better banks wherein you have a better flexibility who's offering a better interest rate. As you are aware, the repo rate has increased from 6.5% yesterday itself from the RBI governor. So I don't personally feel that increasing the limit for from 15 lakhs to 30 lakhs is going to benefit any particular person. But however, one benefit people tend to forget is even if you are going to invest in ATC, you are able invest in senior citizen scheme, you will be able to claim benefit under section ATC under chapter 6A reduction. The next one. This is an amendment. I'll just explain you. See, what happened usually is if you are a not ordinary resident gets a gift from a resident Indian. Huh? It was exempt earlier. So if a resident gives to a not ordinary resident, ordinary but not ordinary resident, it was exempt before. Now, because of the virtue of the recent amendment, it is exempt. See, what they have said is, whatever may be the reason, the income deems and accrues in India. So this is an income arising from India. Hence it is taxable in India. Are you able to see the whiteboard?
No, sir, it is not visible.
I'll share it over here. Okay. Oh, but the PPT goes off. But the PPT is not visible. You'll have to again add the PPT.
Sir, we cannot share both.
No, madam, you can do that. You're able to do it? Or you want my team to do it? Matlada. Gangadhar phone just matlada.
Participants can pin so that they can see both the screens.
Okay, can you? Okay, I'll tell my team to do it. The name will be Gangadhar. You just tell him allow him as a ping.
Yes, sir.
Okay. Okay, let's go to section 50A. See, market linked debentures. Any profit or gain arising from sale of market linked debentures are always short term capital gain. What has happened all these days is, as you are aware, how capital gain is being calculated, sale consideration minus cost of transfer is net sale consideration. You reduce cost of acquisition. If it's more than 24 months, it's long-term capital gain, and this happens index cost of acquisition. So what happens in this case is, why market linked debentures, we are getting interest every year over here. That is, time value of money is being calculated already over here. If you again take this interest, add the give the benefit of indexation over here, there's a double benefit to the assessee and a loss of revenue to the government. So what the government has come with the amendment of 50AA says that any debentures which has been market linked is always short term capital gain. You don't get a benefit of long term capital gain of that. That is, your benefit of indexation will not be there, irrespective of whether it is a short term or a long term. Number. Then section 48. See, what happens is section 48. Hope you are aware. I'll just repeat what we were doing for capital gain. So sale consideration minus cost of transfer is net sale consideration minus cost of acquisition or cost of improvement index or this thing. So what assessee started to claim is, you are paying interest under section 24A for interest on principal of interest on housing loan. There is a limit of up to 2 lakhs. So what has happened is, people are taking benefit under section 24A of the Income Tax Act for 2 lakhs and also adding this 2 lakhs into the cost of acquisition. They're adding this amount so that there is a double deduction benefit. You're also claiming, when this is happening, cost of acquisition, they are also adding this interest that I have paid during this amount. I paid for this amount, I'm claiming this benefit also. What the government is telling currently is, you can claim either over here or here. There is no double benefit which you can claim. So there is that 48 section which helps you out to remove this ambiguity in the law. Okay. So we'll go ahead with the new tax slab. So as you are aware, there are new regime under the old regime. We'll do a comparison study between new regime and the old regime. As you are aware, up to 3 lakh rupees, the zero tax payable. 3 lakh 1 rupee to 6 lakhs, it's 5%. 6 lakhs to 9 lakhs, it's 10%. 9 lakh 1 to 12 lakh. I hope you're able to see it on the PPT. So
Yes, sir.
9 lakh to 12 lakh, it's 15%. 12 lakh 1 to 15 lakh, it's 20%. Above 15 lakh, it's 30%. That's the new tax regime. We will do a comparative analysis in detail so that you'll understand how it's going to work and how you're going to take benefit of it. And coming back to the old tax regime, you are aware that up to 2,50,000 it's nil, 2,50,000 to 5 lakhs it's 5%, 5 lakh to 10 lakh it's 20%, above 10 lakh it's 30%. You need to add education surcharge at the rate of 4% for everything. So we have made a comparative. Can you open the PPT? PPT next. Madam, can someone help me open the PPT? We can do it with the
PPT is shared, sir.
Oh, you have shared the PPT to the participant.
No, sir. It is shared on the screen.
No, I'm not able to see it. No, it's not visible. Or you take the PPT. This will be, it's okay. That will be a better thing rather than this. Okay. The next slide. Yeah. See, what we have done over here is what all deductions can be claimed in the old regime and what all deductions cannot be claimed in the new regime. The first thing, there are very few basic deductions allowable in the new regime. The main government, the whole thought process of having the new regime is to increase the spending regime. So what the whole thought process of the government is that the more you spend, there is more growth in the economy and the GDP and the economy grows. That is the whole thought process in the present government. However, in the previous government, what people used to think is we as Indians, we used to always think of saving a lot of money for a rainy day. What happens for your children's education, marriage, you need to own a house and things as such like that. But this government is more focused towards spending, having more money in the pocket so that people spend more and the economy grows at a faster pace. So because of that, the government is pushing for the new tax regime. As you are aware, maybe less than 5% have opted for the old previous regime, and not many have happy with the old regime. That is why they have this incentivize of this new 50,000 of standard deduction to help people, incentivize them to join the new tax regime. So I'll just tell you a few deductions which are allowed in the new tax regime. Transport allowances in case of a specially abled person. If you are a specially abled person with some disability, you have some transport allowance which you can claim it as a deduction. The next comes as conveyance allowances received to meet the conveyance expenditure incurred as a part of employment. See, it is basically in simple layman's term, it is just that reimbursement. That is the cost to cover such expenditure. So assume you get an amount to pay for a bus fare. That same amount needs to be reimbursed. There should be not an element of profit. Only that can be claimed as a deduction. Then the next thing is, in case there is a transfer from your home city to the other city, that cost incurred for such transfer, that you can claim it as a deduction. The next thing is deduction for employees' contribution to NPS. This is one thing which is there as a good benefit. You can claim up to 50,000 as a transfer to NPS, which was not there earlier, which is an amendment to in the current year budget. Next, one more thing is daily allowance received to meet the ordinary course of expenditure from your regular place of duty. So this is just 5-6 small deductions which is allowable under the new tax regime. However, you need to take care which regime, in the older regime, what all deductions were allowed and which you cannot claim. The first thing is 80TTA, that is your interest on savings bank account. That is one thing which is left out. Professional tax. In Karnataka, you pay a professional tax of 200 rupees per month. That translates to 2,400 per year. That you cannot claim in the new tax regime. Entertainment allowance on salaries. Entertainment allowance is usually paid to government employees. So that any allowances which you can claim before is not deductible now currently. Leave travel allowance, LTA, not allowable. House rent allowances, majority of them claim HRA because either they would be staying in a rented house or they would have been paying rents to their parents and getting rent receipts. The other thing is helper allowance, children's education allowance, and other special allowances. This is one major thing which is not allowed in the new deduction is the interest on housing loan. If whether it is a self-occupied property or a vacant property, you cannot claim a deduction of 24A. That is up to 2 lakhs. You could have claimed in the old regime, which cannot be claimed in the new regime. Chapter 6A deduction, 80C, 80D, 80E, and 80CCD up to 1,50,000 for your new NPS scheme. All that cannot be claimed in the new tax regime. Exemption or reduction on any perquisites that you cannot claim. So this is the exhaustive list which for which you can claim a deduction and not claim a deduction. We have made a comparative study wherein what happens, what is your earnings, and what all deductions on an average you have it, and what is the gain or loss you get it. If you can just move on to the next slide. Yes. We've just made an assumption saying that you are going to earn around 7.5 lakh of CTC. So what is the taxable income? What is the tax payable and what is the gain? See, we have made a standard assumption saying that 80C, you are going to invest 1.5 lakh. 80D, it's 25,000 on health insurance, and 80CCD, that is the NPS, that's around 25,000. So it's a comparative study wherein for such an investment planning, there's a net profit itself. That is, there is a gain of around 40,000 in the first place when you're earning a 7 lakh. You have a gain of 39,000. So you can just read out it and understand. We can go to the next slide. Yeah, this is as per deduction as per old tax regime. See, as per my understanding and my knowledge, if you are a conservative guy who's going to look out for housing loan, you have an NPS, you have an ATC, you can go for this. So what happens in this is, assume you have, I'll just go through how we have done it. Assume you have a 10 lakh rupees of Assume you have a 10 lakh rupees of salary and you have 20,000 rupees from other sources. Maybe it is an interest income or a dividend income. You are eligible for 50,000 standard deduction. Where about the older scheme, you have a 50,000 of standard deduction applicable even for a new regime, applicable even for an old regime. You can make an investment up to 1,50,000 under ETC. It can be a PF. Yeah, so there's ATC, investment from ATC, you can be PF, EPF, senior citizen scheme, Sukanya Samruddhi scheme, life insurance policies, term deposits, you can do anything. And you can do 50,000 under ATCCD. See, ATC and ATCCD in together, you can claim 2 lakhs in total. Not many people are aware of that new section. It was introduced in 2015, if I'm correct. So that 50,000 additionally you can claim, and your housing loan interest of up to 2 lakhs. So what happens is either you can claim a HRA or a housing loan. You cannot claim both unless there is specified conditions wherein it is you can tell the assessing officer this: I am also living in a rented house, as well as I have bought a house which is not convenient for me to move to the office place. Then there is this medical insurance for your own family, that is 25,000. So 25,000 includes 20,000 of medical insurance and 5,000 rupees of health checkup. So that is one additional benefit you can take from here. Second one is medical insurance for your senior citizen payments. That amounts to 50,000. So there is a total deduction of 5,000. So what happens over here is the net taxable income is 4,95,000 over here. So even in the old tax regime, if you are earning an income of 10 lakh and you plan your tax in such a way, your income becomes zero. There is one thing where you can work out on your taxes and people are not willing to pay more tax. You can think in such way. One more thing is, which we have not considered over here, is you can think of NPS from the employee. 10% of your gross income can be 10% of your gross income. What happens usually, whatever happens is, in any employment, your CTC is confirmed. You can structure in such a way that you can be tax compliant. It'll help you save a lot of tax. What happens over there is, you can structure 10% of your gross salary, your monthly salary, and then put it into NPS. What happens is, in that case, your take home might be lower side, but you end up saving taxes because of that. Going to the next slide. So one more change which has happened is the leave encashment. So what we have done is just to give a recap about leave encashment. It's very easy if you go with the flow. When is the leave encashment received? If the leave encashment is received during the employment or during the period of service, it is fully taxable, irrespective of your employee, irrespective of whether you're in a government service or in a private service. It's taxable for both of them. However, if it is received during employment, for government employee, it is totally exempt. So there's no tax payable for leave encashment for government employee. If for other employee, the least of the four is exempt. I'll just tell you with an example in the next slide. I'll tell you what is the thing. It was earlier up to 3 lakh rupees, it was exempt. Now that limit has been extended to 25 lakhs. This is going to help people who are going to retire or on the verge of retirement from financial year 23-24. So going to the next slide, we'll just give you an example how to calculate leave encashment and how it is going to help you out. So Mr. A is retiring after 15 years of service. Mr. A was entitled to 35 days of paid leave per annum from his employer. Overall, he had 525 days of leave during his entire service. That is 35 days into 15 years of service. Out of this, he's already utilized 200 days and he's left only with 325 days. So last 10 months salary was 33,000 as per this example. So he received 5,75,500 as leave encashment from the employer. So how much is exempt? How much is taxable? So going by this example, the amount of leave encashment received is 325 days into 1,100 rupees per day. The lower of the four is exempt. The one is the amount notified by the government. If you can recall over here, instead of 25 lakhs, it was 3 lakhs earlier. It was long due for increase in the limit, but happily the government is done currently. The next thing is actual leave encashment received 3,75,500. Average salary received for the last 10 months. So 33,000 was his average salary for the last 10 months. So it comes to 3,33,000. The fourth one is 30 days for each completed year of service. So 1,100 into 15 days for 15 services, 15 years minus what is already claimed. So this comes to 2,75,000. So what happens over here? The lower of the three is exempt. So in the present case, the lower amount is 2,75,000 and 82,500 becomes taxable. The whole change over here is the limit of 25 lakhs has been increased to 25 lakhs from 3 lakhs. Can move on to the next slide. The next slide. Okay. As I told you earlier, it's a one-time option where you can go into the new scheme. If you're going out of the new scheme, there is no possibility of you to coming in. So this is a hindrance what the government has given, which will force you to move into the new scheme. So for other than a business employee, there is no form which needs to be filled. You can file it with your income tax return and file form 115 BAC. The new tax regime is going to be the default tax regime unless you opt out. However, for non-business for business assessees, you need to file a form before filing your income tax form. The next slide. There is a little bit of changes in section 44AD. Before going to that, I'll just explain you what is 44AD. See, 44AD please understand, it's a very good section where a lot of small taxpayer can get benefit because of this. So 44A can be allowed for an individual, HOF and a firm. Only 3 class of categories can benefit from this section. 44AD is a presumptive taxation method wherein you pay tax at the specific rate of duty and there are no books of accounts which needs to be maintained except a few. So only 3 classes of assessees can claim. One is your individual, your HUAF, and a partnership firm. Companies and LLPs cannot claim that benefit. But for a firm, it is not lucrative enough because you are already there in a 30% tax slab. So what happens in 44AD? So as you're aware, you need, in case your turnover exceeds 2 crores, you need to get tax books of accounts audited by a chartered accountant under section 44AB. So this is a mandatory rule wherein in case your turnover exceeds 2 crore, you need to get your books audited by a chartered accountant in section 44AB. However, in case your turnover is less than 2 crores, what needs to be done? The government has come up with this fantastic thing. So assume your turnover is 1 crore. You have a 50 lakh of cash sales, 50 lakh of other than cash. Government has told, just declare 8% on this cash sales and 6% as your income from business or profession. So section 28 to 44, the provisions applicable for income from business or profession are not applicable. Any disallowances, you need not maintain your books of accounts except your sale receipts and your bank statement. You need not maintain anything. So assume 32 section depreciation under the income tax act. You declare this much of as a percentage of your sales. It is assumed that depreciation is already given to you. 43B, we'll have a detailed discussion on 43B subsequently. There are certain disallowances if you're not making a payment before the end of the financial year. There are certain disallowances which needs to be added back. They will not be allowed as an expenditure. These cannot be allowable expenditure. 40A3, that is cash expenditure in excess of 10,000. I guess you are aware that any expenditure in excess of 10,000 cannot be made in cash. It is made in cash, it is disallowed. So all these income tax expenditure sections from section 28 to 44 will not be applicable if you go for 44AD. That is simple thing. I'll just tell you again. Government says only 2 things. Declare your cash sales at 8%. Other than cash sales at 6%. It is deemed that all the provisions between 28 to 44 are complied with. So this is the essence of section 44. So what happened? What is the amendment? Are you clear with this? Only if you're clear with this, you can understand the new amendment. Or you want me to repeat?
It's clear, sir.
Huh? You want me to repeat? I'll repeat if you want.
No, sir. It's fine.
So what has happened over here is, so government has given this threshold. Government has given this threshold. So up to 2 crores. So up to 2 crores. So up to 2 crores, you need not have any books of accounts as prescribed under 44A. So what has happened is, your books of account, your detailed books of account, your invoices, sales, purchase, expenditure, books of accounts, ledger entries, trial balance need not be maintained if you're going under 44AD. Up to 2 crores. Now, what is the amendment in the current budget? See, this 2 crores has been increased to 3 crores. This 2 crores has been increased to 3 crores, provided your cash receipts it doesn't exceed 5%. You can, the threshold limit of sales up to 2 crores has been increased to 3 crores, provided your cash receipts, that is your cash sales, doesn't exceed 5% of your total turnover. So what you can infer from this is simple understanding. Out of 3 crores, assume my turnover is 3 crores. So 15 lakhs is the maximum limit I can have cash sales. And 2 crore 85 is the other than cash. So this is one benefit where you can claim your books need not be audited for sales up to 3 crores, provided you fulfill this other condition. That is, cash sales should not exceed 5% of your turnover. However, the older section is still applicable, wherein assume your turnover is 2 crores and you have 100% of cash sales. You can still go for 44AD and declare at 8% for your cash sales. However, once your threshold limit of 2 crores exceeds, to assume you have a 2 crore 1 rupee sale, you need to look into this section where it says that your cash sales should not exceed 5%. You can only take the benefit only if there is that less than 5% of sales. Otherwise, the older provision continues to exist and you can continue doing that. Do you want me to repeat?
Participants, if so, please put it in the chat box. You will not be able to unmute yourself, but we'll pause for a minute, sir.
Yes, sir.
Participants, if so, please let us know. You can use the chat box or you can raise your hand so that we can unmute you and you can ask your question in case. Otherwise, it's fine. So I don't see any questions, sir, so you can proceed.
Okay. So similarly, for professionals, there's something called as 44 ADA. What happens over here is, for 5 classes of business professionals, doctors, engineers, chartered accountants, marketing professionals, and other set of clients, they can go for a section 44 ADA, wherein 50% of their expenditure, they can claim it as an exemption. So assume I have, this was already there in the prior to the budget. So I have a gross receipts of 50 lakhs. So I can claim under 44 ADA 50%, 44 ADA, 50 lakhs of gross receipts I have, 44 ADA, I can deduct straight away 25 lakhs. I need not maintain any books of accounts. I need not have any bills, vouchers, anything for this 25 lakhs. Straight away, I need to do my gross income from business and profession is 25 lakhs. So this is something about 44 ADA. What is changed in this? So in this, from 50 lakhs, the limit has been increased to 75 lakhs. There is an increase of 25 lakhs in the limit, provided there is one more condition added to that. 5% of the gross receipts should not exceed 5 lakhs. 5%. So I'll just repeat once again. So my gross receipts should 75 lakhs, and it should not exceed 5% of the total as cash. So 5% of 75 lakhs, 3.75 lakhs, it should not be cash receipts. Then only I will be able to claim this benefit of 44 ADA. Both are amazing sections which is going to help a lot of small and medium taxpayers, because maintaining books of accounts is very difficult, and complying with all the sections from section 28 to 44 is a huge compliance burden. So I would suggest someone looking at 44 AB not going out of 44 AB. There is one more thing which has been coming, which is there in the section, is for 5 years, once you go out of 44 AD, once you go out of 44 AD, you cannot use 44 AD for the next 5 years. You need to use normal scheme. That is, prepare your balance sheet, sales, purchase, expenditure, get it audited by a CA. So one thing, when you are going out of 44 AD, you will have to think twice. Okay, I'll just read out easily for you the features of presumptive scheme. I've explained everything to you. You'll have to declare your profits as per presumptive scheme. That is 6% or 8%. For 8%, it is your cash sales. For 6%, it is your other than cash. Your turnover should be less than 3 crores. So your turnover should be less than 3 crores, and less than 5% of your cash sales should be there. Receipts in cash should be less than 5%. You don't have to maintain any accounting records. You don't have to get your books audited by a chartered accountant. We can go on to the next slide, section 44 ADA. Are you able to see the PPT?
Yes, sir.
Okay. So section 44 AD of the income tax, as mentioned, the earlier limit was 50 lakhs of gross receipts. That has been increased to 75 lakhs. What has happened over here is, again, that 5% of gross receipts should not be in cash. Coming to capital gains, section 54. So as you're aware, how do we calculate capital gain? Sale consideration minus cost of transfer is your net sales consideration minus your cost of index cost of acquisition, index cost of improvement. So the government has amended. So this is your long-term capital gain. This is how we're going to calculate long-term capital. So what has happened over here is the maximum exemption allowable under section 54 and section 54F has been capped to 10 crores. So it's not going to help hinder us. It's only for large taxpayers whose long-term capital gain has exceeded 10 crores, meaning your total sale consideration minus your cost of transfer, minus your cost of acquisition, minus cost of indexation, the total profit and gain, that is your long-term capital gain, has exceeded 10 crores. It is only then there is a upper cap limit of 10 lakhs. Section 54 and 54, the maximum benefit allowable has been capped to 10 crores. Going to the next changes under capital gains, conversion of gold into electronic gold receipt and vice versa. See, the government has come up with this new scheme, electronic gold receipt scheme, which the NAC BSc gives you. See, as you know, we import a lot of gold into India, and that causes a lot of drainage of valuable foreign currency. So, in order to stop that, the government has made a policy, or to incentivize people buying physical policy, there's something called as electronic gold receipts. So, assume you have 100 grams of gold with you, physical gold coins. You go to the BSc or an intermediary, he gives you a certificate saying that you have given him 10 grams of gold and you can get that back whenever you want it. That is, it is as good as the physical gold which you have been holding it with you. So it's just an electronic certificate which has been issued so that you can pledge the gold, give back the gold to them, and vice versa. Whenever there is a requirement for you to get your ornament or an investment or selling back, you can do that. So the government has come up with this new scheme. So what is this exemption? When you are going to convert the 222 says that there is a transfer. That is, when your conversion of gold into physical, they feel it as it's a sale. On any point of sale or a transfer, there comes capital gains. So what happens when capital gain comes? You need to pay short-term or long-term capital gain, as the case may be. But the scheme was initiated by the government to promote government gold bonds, EGRs. So what the government said? Over here, you're not selling anything. You're just converting your physical gold into electronic gold receipts. That is, it is not treated as a sale. When it is treated as a sale, when you sell that to a third party, then only it should be treated as a sale. So there is no capital gain arising of such transfer. And further, even when you're going to sell it, that period where that conversion and reverse conversion was there, it will be included in the period of holding. So assume, I'll just give you a small example. 1/1/4/20, I bought 5 grams of gold. 1/4/22/23, I get an EDR. 31/3/24, 25, I again convert into physical gold. So this period of holding will be from 1/4/20 to 31st March 25. That is 21/22 is my period of date of acquisition. 2021, I'm sorry. 2021 date of conversion. When I sell it over here, the period of holding will be from this 20 to 25, and not only when this period. This is the relaxation they have given. This is just a scheme to help people convert their old gold into EDR, so that the forex is going to be saved and people, there's no drainage of foreign currency and extra stress on the foreign currency. Going to the next TDS provision. See, I guess why, are you aware that why TDS provisions are into action? There are 2-3 major things why TDS provisions are there. One is a continuous flow of revenue to the government. So what happens when there is a TDS deduction? We pay only advance tax 4 times a year. However, TDS payments are going to the government on a monthly basis. You need to remit the TDS deducted in the previous month by 7th of the subsequent month, as the case may be. So there's a regular payment of dues to the government. The second thing is tracking of income. So what happens is tracking of income. Assume you get a 5,000 rupees of 5,000 rupees of commission. And we'll do it 10,000. So there is a 30% tax deducted at source. No, 5%. Give me 1 second. So you have got a 10,000 commission and tax has been deducted at TDS at 194H at 5%. So what happens? The amount of 5% is not so significant for the government. But what happens over here, once you deduct this 5%, you are forced to give your PAN number into your person who's going to deduct that commission income. And you will be forced to, since this 5% will appear in your annual information system as well as in your form 26A, you will be forced to declare this 10,000 as your income, and which will lead to more payment of taxes, since you will be higher in a higher tax bracket rather than the 5% tax slab. So you end up paying, if you are in the 20% tax slab, you end up paying 20 to 30% of the tax, where TDS is only a minor component for them. This will ensure that there is more and more compliance and people are bought into the tax net. That is the whole concept of TDS, so that it helps people to get bring a lot of people into the tax net. So there are 2-3 minor changes in the TDS provisions. One is the tax rates on EPF withdrawal has been reduced from 30% to 20% in case of non-PAN. The second thing is TDS on winning from online. TDS on winning from online gaming. See what happened. There was a prior section called as 194B and 194BB. As you're aware, there is a lot of this online rummy and all that stuff coming into picture today. So what does 194B says is you need to deduct TDS at 30% in excess of 10,000. This section comes if you are having any winning from lottery, you are having any winning from lottery or online games or gambling, all that thing, you have to deduct TDS at 10,000 rupees if that exceeds the threshold. What these companies, the rummies, interpreted is that this is per instance and not for the whole year. So what happens? Assume today 10,000 is the winning. They just deduct 10,000. They will make sure that you withdraw 9,999, and they don't deduct TDS over here. Subsequently, tomorrow you can again claim this benefit of 10,000 because this is per instant and not for the whole year. So they have interpreted in such a way that this 194B and 194BB, this 10,000 threshold limit is per instant and not for the whole year. So due to this, there was a lot of misuse of this section, and in order to get that benefit, the government has introduced the new section. I'll just read out the new section. So it just remains the same, but what it says is, in total, if it's going to exceed per withdrawal, it is that one limit of 10,000 rupees is for the whole year and not for one instance. So I'll read that thing for you. TDS on winning from online gaming will be deducted either on withdrawal or at the year-end account balance, and no threshold limit has been provided. There's only one instance of 10,000, nothing more than that, and that will be applicable to TDS. at 30%. That is one change which they have got into. That is to one more changes which has come is the 43B disallowance. It is one major benefit which has helped the taxpayer, MSME. See, what has happened is, as you are aware, 43B, these are certain 6, 7 explanations given in 43B, wherein which says that only a certain expenditure, if paid, will be allowable as expenditure. So what happens over here is, only if that particular payment has been made, payment for such expenditure, only if such expenditure has been made, only then you can allow it as an expenditure. Otherwise, you need to add back that particular expense as an disallowance. So what they have added is, they have added, if it's a micro or a medium or a small enterprise, payments needs to be made. Payment needs to be made. If there is an agreement, if there is no agreement, within 15 days. If there is an agreement, before 45 days. So payment needs to be made before the due date. And only if you're going to make payment after the subsequent dates, it will be allowed only in the year of such expenditure. So assume, I'll just give you an example, it will help you understand the thing easier. Assume I am a MSME registered dealer. I have supplied to one particular vendor in the year financial year 23-24. I have supplied on 1/4/23. Payment has been not made until 21/31/3/24, and payment is made subsequently. That is 1/4/24. So the purchase bill, what that he is considered, will not be allowed as an expenditure. It will be only when, assume he's going to pay it on 1/4/24 for me, only at that point of time he can claim that particular expenditure. So this is one big major move because it's going to help a lot of people who are registered under MSME Act. All the micro, medium, small enterprises, if they are registered, it will help them in a big way. They can also claim interest and also have a benefit in a big way. So one biggest move, what I liked in this budget, is this amendment of section 43B, including the expenditure for that MSME dealers. Going on to the next change, see, in case this is just to promote new agriculture and new cooperative societies. So they have 1 year of benefit, wherein if a new cooperative society is there, set up from 1/4/23 to 31/3/24, you can claim a concessional rate of tax at 15% under section 115 BAE. This was also given for 1 year for private limited companies. However, this is a benefit exclusively applicable for cooperative societies. The next benefit in the budget is the revamped MSME scheme. The government has proposed a new funding for the MSME, which is a great help actually, in fact, to MSMEs. Then there is a new Vivad Se Vishwas. See, that was because a lot of time and money is lost into litigation. So in order to save that, the government had introduced Vivad Se Vishwas to certain taxpayers, so that you pay a compromise, pay a certain sum, get it resolved, so that we don't want to drag on things on a longer duration, because there are much more productive things. And it is also because the law was not clear on certain points previously. So in order to give that clarity and that increase the climate of certainty in the organization, in the country as a whole. The government has planning to come up again with the new scheme. And one more exemption is for startups, wherein in case there is a loss, that loss can be set up. The loss can be carried out for startups for exceeding 10 years. All losses could be carried forward only for 7 years. Now, because of this amendment, it can be carried up to 10 years. We'll have a few, 2-3 small changes in any queries in the direct tax, or you want to complete 2-3 pages of the GST and complete of the whole seminar?
So you can continue, sir. After that, we can come back to any questions.
Okay. So there are only a few 3-4 changes in the goods and service tax, and the rest are just procedural changes. So because of that, it will not help you in a great way. Only 3-4 basic changes I will tell you. See, there's something called a CSR. Corporate Society CSR is section 135 of the Companies Act, says that if your net worth is exceeding 500 crore, turnover 1000 crore, net profit 5 crores, you need to spend 2% of your net profits as CSR funds, corporate social responsibility. So what has happened? The Companies Act mandates that this needs to be spent, 2% of your net profit needs to be spent as corporate social responsibility towards your organization. Now what has happened? Assume you incur this 2% of your expenditure for certain CSR, whether input on the same such expenditure. Assume you do an marketing or donate books, do a marketing campaign, or a blood donation camp, do any particular thing out of these funds, and whether you can avail input tax credit out of the same, because the law itself is mandating me to spend 2% of my net profits on corporate social responsibility. Whether the input tax credit on these can be availed. Previously it was allowed, but due to the amendment in the Finance Act 2023, this input is ineligible. This is one small change which is happening in the Finance Act 23. The second one is previously the GSTR 3B would not allow us to put negative figures. Now that has been complied with, and you can put negative figures. That is reversal of tax inputs, negative inversal, that they've allowed. The third thing is, if you're under composition scheme, you are not allowed to do e-commerce sales. E-commerce sales could not be done if you are there in a composition scheme. But however, the law has been amended to help composite taxpayers also. Because one thing why is composition scheme cannot make interstate sales. They have to do states intra only. That is, sales needs to be made within the state. However, if there is an e-commerce, you would have no control where the goods is going to go. So that was just one lacune, and people were telling, if you're going to do e-commerce sales, you have to take a regular tax registration and not go through composition scheme. However, the Finance Act has cleared that, saying that even though you are a composition taxpayer, you are now eligible to do composition e-commerce sales. And the last slide, the time limit for filing is 3 years. GSTR 1, 3B, 9, 9C, and 8. 7, I'm sorry. You have 3 years. See, you cannot have an end. You cannot keep without an end date. You cannot continue filing your returns. So assume your April 21 return needs to be filed by 20th. I'm talking about GSTR 3B. 20th of May 22. So the maximum due date till when you can file is 3 years from the end of May 22. That is 2025 is the last date where you can file this return. This is the last date till when you can file a return. So that has been clarified in the Finance Act. With this, I conclude my session, and in case there's any clarification, please let us know.
Thank you,
Or
sir.
you want me to repeat anything, I can help you out.
Thank you, sir. Participants, in case you have any questions, 1 minute, let me unmute all of you so that 1 minute, please. One minute.
Participants, if you have any questions, you can drop it in the chat box, or else you can unmute yourself and you can ask the questions.
Yes, sir. I have one question.
Yes, sir.
When you have said in GSTR 3B, negative numbers can be given. So with respect to purchases, you have referred that you can give negative numbers. What about sales part also? We have got that
Yes,
clarity?
you can do that. Yes, that you can do that now. All these days you were not able to do it, but now definitely you can do that.
Okay. Next thing, what I wanted to add up is when for regarding input, when we were taking, so we used to give gross numbers under category of all other ITC, and the credit notes or debit note, wherever the reverses we were giving under others category, which was not getting auto-populated earlier. Now they are trying to give net number in all other ITC.
See, one thing, see, what one people are not aware of is who should issue a debit note or a credit note. People are not aware who should, in the GST regime, who should issue a debit note or a credit note. You tell me one answer simply. The supplier of the goods should issue the debit note or a credit note. See, what
Correct.
happens usually is, usually both the parties issue it off. That is the general prevalence, what is happening in the industry today. But what happens is, when one of the party does it, you get that auto-populated thing. So what you can tell your clients or your reference, that the supplier of the goods needs to upload the credit note or a debit note into the GSTR1. That time it will help you and get auto-populated.
Correct. So it is better to give net. For an example, gross number minus my credit note net number I should give in all other ITC, or I should give others category as reversals. For credit
See,
note.
reversal, I don't agree to that point of view, because see, what happens is when you put that reversal when it is ineligible.
Okay, correct.
So I won't suggest you doing that. You can be susceptible to a notice. So I don't agree to that point. You should
Okay.
put a reversal. Reversal is not a correct way of putting it.
Okay, thank you.
Thank you.
So we have one question in the chat box.
Yes,
It is
ma'am.
asked by Gaganashri. She's asking which tax regime is better, old or new one?
Madam, there is no one single answer for that. It depends on multiple factors. Because see, what happens is, it depends on what is the salary you're earning. See, in our comparison itself, there are certain clients where new tax regime is beneficial. If there is no investment that the client is willing to do or the assessee is willing to do, then definitely new tax regime is better. However, in case he has a HRA, he is going to pay rent. He's paying rent. He is willing to do investments. He has a housing loan. So there are multiple factors which are to be considered before we come to a conclusion.
So we have one more question from Bhavana. In case of cash withdrawal from bank in a financial year, is there any tax levied on that?
Yes, madam. See, what happens is the limit is up. Actually, the limit is up to 1 crore. So you can withdraw cash up to 1 crore. But what has happened is the income tax has levied a cap over here. So you can withdraw freely up to 20 lakhs. Up to 20 lakhs, you can withdraw cash without any issue. But post 20 lakh one, you need 20 lakh rupees 1 rupee, 20 lakh 1 rupee. You need to submit your 3 years ITR. That is your 3 years acknowledgement of your income tax return, saying that I am a taxpayer and I have been paying tax. then only they will not deduct any TDS. TDS under 194N will come. Provided you give this certificate on the ITR saying that I have filed my income tax return for the previous 3 years and before the due date, then up to 1 crore, there is no TDS for you. But if you have not filed your return prior to the 3 years, it will start from 20 lakhs itself at 2%.
So one more question from Manjesh is asking which one is more beneficial to individual, buying physical gold or paper gold or sovereign gold bond?
See, what happens is there are multiple things. What I personally feel is if you buy physical gold, it should be in the purest form. It should not be in the form of ornament. What happens if you buy something in an ornament? There is an impact of making charges. So 10 to 20% you end up straight away losing on the making charges. So your investment on gold will not yield you any extra benefit. When you're going to sell it back, there are going to be 20% of less making charges because it's in the ornament form. Whereas what happens in the gold bars and the sovereign gold bonds, it is net to net figure. Assume you're going to buy 10 grams of gold, you have 10 grams of gold with you. Whereas in an ornament, they deduct 20% as a making charge. So buying first point, ornaments is not a no-no. You can either buy EDR or you can buy sovereign gold bonds. Sovereign gold bonds are a good thing because see what happens, it's a long-term benefit. You are getting a discount if you are a retail investor. The third thing is you're getting interest at 2.5% per annum. So all these three benefits, I feel sovereign gold bond is a better option.
So what about the e-currency or e-rupee launched by RBI? Is it a game changer like RuPay card or UPI?
It needs to be tested. Because what happens is, I told you, what happens, they want to compare it with a Bitcoin and Ethereum. What happens is once it goes out of the currency, it's very difficult for the government to track. It can go into the crime proceeds. It can go into drugs, crime. All that you need to take care. Now, see, assume you are going to see what happens with the e-rupiah. The people lose track of where the money is. There is no money trail left in it. So because of that, it becomes very difficult for the government as a tax compliance. If it's going to terrorism, who's going to control, right? Funding is stopped today currently to terrorism. But with e-rupiah, you can definitely, because there is no trail. You assume I buy a lakh rupee of e-rupiah today, and I transfer it to you. You transfer it to someone else. The person whom you are transferring, the government has no control on it. So that's the main thing. Time will tell, but UPI is a game changer.
Sir, does there is any tax deductions in new regime like ATC, ATD?
That we have given a detailed chart. You could have checked that in the thing. Just to give you a recap if you want, the only 5-6 sections which are allowed in the new tax regime, one is that, give me 1 second, I'll read it for you.
It's okay, sir. I'll refer it.
Yeah, it's there in the thing.
I'll refer it, sir. It's okay. Sir, another one. I have filed my returns for 2 years. I did not file my return. Okay. Can I update my returns and file it again?
Definitely, but there is a penalty for that. 1,000 rupees you need to pay for a nil return as well.
Based on whatever income it may be there.
Not based on. I'm talking for a basic return. Nil return.
For the basic return. Okay, sir.
Yes, for the nil return.
Okay.
So just to tell you, there are 5 allowances deductible under the new regime. One is a transport allowance if you are a specially abled person. Conveyance allowances, that is a reimbursement. Then any compensation received to make the costs of transfer. Then benefit what you get is ATCCD. That is allowed. ATCCD contribution to NPS, that is one of the biggest exemption what you can claim. Apart from that, there is nothing else.
The last question, sir.
Yes.
Suppose a person has a gold shop and income tax people has come to the gold shop. Correct. And they have made a raid and they have filed some sections like 60, 61, 62 something. Correct. So in that case, What is the answer the gold shop person can give, so
See,
that he
what-
can get less income tax?
See what they do is they'll prepare a profit and loss account for that particular day. Assume 9th of 10th they have raided. So 9/23 they will prepare a balance sheet for this person. So from 1/4/23/22 to 9/2 they will prepare a balance sheet. They will ascertain what is the closing stock, how much of sales were concealed, how much of income was concealed, what was the closing stock as per books of accounts for 31st March 22, how much is the actual, whether they have, what is the means of evasion of tax is done, whether there can be 2-3 major evasions what he can do. One is under declaring sales. He will not show sales. Other thing is increase of closing stock. What happens is closing stock he will not declare. Purchase he would have done, but sales he would have not declared. So there will be an increased closing stock. So he will put this profit and loss account for that particular day and ascertain.
Sir, he will take the entire stock as an income,
No. He cannot take.
but he will file the sections, no, sir, under saying that this is. So in that case, I can say that it is only a business income. It's not an this income. I can say this answer.
No. See, what you can say is you need to ascertain what is the amount which is in excess. You would have shown what is the cost of, what is the closing stock, what is the excess closing stock. What happens usually is closing stock will not be as per actual. There may be overstatement or understatement. It depends.
Okay.
So you need to consider multiple things before going there.
Okay. Thank you, sir.
Thank you, sir.
So last question.
Yes.
How about the contribution to Agnivir Corpus Fund? Is there any limit for it? This is a question from Satish MD, sir.
There is no limit. It's allowable. Even that's an amendment. Maybe that is not covered in that thing.
Thank you, sir. It was an enlightening